Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone today. Today is Tuesday, January 20th, 2026. And today we're talking about small caps leading as money shifts to the real economy. Although some other very interesting things are happening today, kind of dramatic. We'll talk about those and talk about how tomorrow might be even more interesting um, because of some of the stuff that might be coming to the Supreme Court. So just showing you some disclosures now. Oops, I've got to bring this back. This is my little promotion for our event in Florida. Play this anyway. All right, so we're doing our master class, Derivatives in Focus, in South Florida, the Trade Station headquarters in Plantation, on Thursday, February 26th, and that is near Fort Lauderdale. If you want to come and check it out, I will be speaking along some of these other folks. And if you're interested, you can get this QR code right here and sign up. I'll just share that with you very briefly. And next, I'm going to show you the standardized returns from ETFs. We talk about these on this webinar. Remember on Mondays, and say because it's a holiday, doing the same webinar on Tuesday. But on Mondays, you just stay to the market. We look at the big sectors, the big ETFs that represent those sectors and indexes, and these are the standardized returns of those and some others. Also, if you want to go to tradestation.com, go to Insights, Market Insights. That will take you to our blog. And on our blog, we have this blog post about small caps leading as money shifts to the real economy. So some of the things we're going to be talking about are covered in this blog. Okay. So I will mention that tomorrow there is some interesting stuff that could be coming from the Supreme Court. And it's an unusual day when we're looking as traders and investors when we're looking at the Supreme Court for guidance on things, but it could be market moving potentially, and I think it's important just to kind of know about that. So as you look overall here, there's a few things to say. First of all, when you see the rotation away from the big tech companies historically, when the breadth widens as we've been seeing, and things like small caps and other things start to perform, it has historically correlated with, or it's historically been, something that happens when the market's getting ready to move lower. It's basically what happens is the big leaders stop leading, money goes to other stuff that works for a little while until it doesn't, and then the whole market rolls over. And we are seeing that pattern now. And it's not to say what will happen, but some of those dynamics are in place. I think it's important to realize that. And we are so in my article here, I talk about this section down here, charting the market. You might want to check it out because there were certain things here that are kind of showing that things were getting more sloppy. And I want to look very briefly here at this daily chart. But what's interesting to me is look at all these solid candles. That says that the highs were sold. On Monday we were strong. We had basically a turnaround Tuesday, and then basically all these solid candles says that they were selling. That's an important thing to realize. Another thing is that we now have this is turned into an ascending wedge. I think this is the most important thing we're seeing here. An ascending wedge is something of a false breakout. So look at this high we made literally on the day after Christmas Eve, and then Boxing Day, or December 26th. That was a high. So it's kind of a weak high. Then we go up and we kind of also make a weak high, and then get rejected. So I mean, this could turn into something here that is now problematically. It is potentially more problematic. I think that's just important to realize that structurally, we are seeing things that even though overall things have been there, there are some positive forces we've seen at work. The overall index here is showing some signs here of potential warning. So I think it's important to realize. Now, don't forget that 2025 started with kind of a weak breakout. You see back here, and then we got sucked lower. Of course, there was geopolitical risk, and right now, of course, we have more geopolitical risk. And so these are things now we have to wonder: will it be kind of a repeat of that year or not? It's not really clear. So anyway, getting sucked back down into the range can be a risk, and false breakout, sucked back into the range, ascending wedge. And the thing about the ascending wedge is you make slightly higher highs, you make lower lows, and you don't get confirming to the upside. And this pattern, I'll be honest, has not worked for a while, but patterns often don't work and then they start working again. So I think it's important to realize that this is a potential reversal pattern. And so that's interesting. It's also interesting that we've crossed under basically the low on New Year's Day. And I think that's also, I mean, this weekly low is, I think important. And if we fail to hold the 50-day moving average, we already have a lot of weakness in tech and stuff. These are things that could turn into something more problematic here. So we have had strength in small caps, but it could also be something that is simply that kind of, almost a dash for trash, that is now just turning into, it was what people bought when they were stretching, looking for that last bit of upside, chasing stuff like small caps. And now, if that runs out, then the real substance of the market may be at risk. And I think we should realize that these things are kind of at play. So today we did not get any tariff rulings. Um, we might get them tomorrow, but also tomorrow, Lisa Cook will have that hearing in the Supreme Court, as to whether or not the president can remove her from the board of governors, which in turn would then remove her from the open market committee. So that decision is going to be tomorrow, and I think tomorrow, I mean, it could be a big day. I mean, I don't understand how how the Supreme Court schedules things. I think most people are like, wow, suddenly now we're wondering about how do we know the schedule of the Supreme Court. But the point is that the Supreme Court might issue a ruling tomorrow on the tariff case. They might not, but it might be tomorrow. So tomorrow could be a big day. We might get a ruling on the tariffs. We might get, also, something with Lisa Cook. So both of those are potentially big events. They're not economic events, but they are tomorrow. So that's important, I think, to have on your radar. Also, Trump has said, or somebody, it might have been Besant, but someone in the administration said that we might get an official nominee for the Supreme Court to replace Jerome Powell as chairman this week. So they might make that announcement. And I'll just say overall, if you look at my article here, there's a lot of political drama. It was unusual. I normally wouldn't want to get into stuff like this, but I think it's important to realize that there was a lot of stuff last week, not just Greenland, but there was that thing with Jerome Powell and this, potential, like, probe into Jerome Powell by the Justice Department. There's also been reports that China is limiting sales of the H200 Nvidia chips. That could be China kind of, pushing back on the United States for stuff. So I think when you look at it, there was also this idea that we almost had some kind of conflict in the Middle East that got pulled back at the last minute. All these things are whirling around right now, and I think we're actually at a spot now where the political risk is actually increasing. This question with something like Greenland. There was also this idea of limiting credit card, rates at 10%, things like that. And then, shortly before I started this, I saw there's a headline that Greenland apparently sold $100 million of treasuries. So I mean, a trade war turning into a financial war, maybe not. All I'm saying is, like, these are now things that could be on the table and in play. And I think we just have to realize that those things are out there. So overall, I don't want to be like overly saying this, but I think overall we have to take a step back and realize that we could actually be nearing the beginning of almost something that could be turned into a secular bear market. And the reason I'm saying that is that gold has been rallying, and that's a big thing. Global has been rallying as well. So bear markets have been associated with strength in gold and strength in global markets. So if you look historically, if we look, for example, at, this is the emerging market ETF. I'm not sure if what we have long term here for global things, but if you look back in the last, secular bear market, if you look back here between 2003 and 2007, the global ETF and the emerging markets did very well, at the same time that the American market, the S&P 500, was basically stuck. See, this was the high of 2000, and this was basically, so this was a secular bear market for the United States, and global outperformed. But what do we have now? We basically have global breaking out to new highs. We have global outperforming. We also now have gold obviously hitting new highs. So these are potentially symptomatic of a secular bear market. And I just want to put that out there, that this is something that, we need to kind of realize. The other thing is, well, I think I'd say is, if that, possibility is correct, or just if it is something that maybe should be considered, is that basically earnings season could become an event when people sell. It becomes an opportunity to basically sell the news, and it becomes a liquidity event. I'm just saying, I think it's something we have to realize. Also, look at the XLK on the daily. This is not, I don't know why this is here. This is all right. This is not a bullish pattern. This is called a megaphone on the tech. ETF, I mean, this is a sign of potential weakness. Remember, we haven't made a new high since October 29th in tech and in the Nasdaq. We've been stuck below this gap, and I think that overall, these things when markets top, they give you signals for a long time before they actually really start breaking. And now the thing is, we have to ask. I mean, this is 3 to 4 months ago. You know, is this telling us something? It's like 2.5, 3 months ago. I mean, is this trying to tell us something? We had this failed to hold the gap, consolidated below the gap. Now we have a megaphone. Look at these moving averages all relatively close together here. Look at the 100-day here. I mean, it just I'm just trying to look at things and identify some patterns here. And we failed to hold these weekly lows on the XLK, which is the most important ETF based on its market cap weighting. It's like technology is a big chunk of the S&P. It's by far the largest sector. I don't have the numbers in front of me, but it's substantial. So anyway, there are things here I think we have to be aware of. So I want to just throw out that if this were potentially something to think about as a potential secular kind of bear market situation, the first thing is valuations. Valuations are high historically, and people have been kind of cognizant of them, saying that the Warren Buffett indicator, which is like the market cap as a percentage of GDP, is historically at high levels, things like that. So one argument alone is based on valuations, but another thing is one of the things that has driven valuations, and one of the things that has driven this bull market for the last 10 to 12 years has been not just technology but software. And we've been talking here about the weakness in software, the IGV, and it really, has been. This is not show. This is the weekly of it. It has been lagging a lot. And on our webinar on Thursday, we talked about how IGV was lagging. Technology. IGV was lagging the cues. All these things here tell us, and I think it's important to realize is that these companies like Salesforce.com and ServiceNow and Microsoft. These are the workmen of the S&P 500. You need to have maybe not the S&P 500 totally, but the technology sector. These are like those major kind of pillars of growth and of the Nasdaq. For the most part, they're not all in the Nasdaq, but for the overall tech trade, and they are showing overall weakness and underperformance and signs of getting sold. And we've talked about before how things like AI threatens some of the software companies. We've also been talking about how there's been a kind of stalling of white collar employment and how in many ways that correlates to a certain extent with software. There's a lot of things here that I think we have to realize are potentially problematic here for software and what that means overall. The question is if something like software really is entering a period of distribution after what has been really, if you look at it, since, since the year, 2011, 2012, back in this, the second Obama administration, when the market broke out to new all-time highs, software has basically gone 8 or 9x to the upside. The question is just, is that done? And I think that's something we have to realize. And if that is done, the question is, does the overall market, can we see new highs on the S&P with such an important sector under pressure with high valuations? And I think that's really an important thing. Now, look at Apple. I mean, we talked about this on TradingView. We did a TradingView ideas, but Apple here, look at this bear flag. We did a TradingView idea on it. You guys can check it out. We did a TradingView idea on that. But look at Microsoft here also. Microsoft, when you look at this, I mean, this is like a double top of different ways you can look at it, but that's basically a double top. And now you can say that it's potentially breaking here. I'm also reading some stuff. I want to just kind of throw it out there. And, when things are negative, people think about things that might be problematic. But I've been seeing reports that people are starting to say Microsoft Windows, the Windows 11 migration has been a problematic experience for their product suite. And also, I think it's important to realize now that, I know enterprises that are migrating full blown to Google. They are using Google for for email and for all the drive and stuff, and they have a full blown use. They're no longer using Outlook, and there's obviously a degree of competition for Azure, but there's also signs now. There have been reports that with Windows 11, a lot that certain people, it's still a small cohort, but certain people are starting to migrate toward Linux and other sort of desktop. There's been certain things happening in the video game space with people shifting to Linux. Now, again, it's very small, but the thing is, when you're looking at a company that is very big, and no one can acquire them, no one's going to take over Microsoft, which means that the only way that the stock keeps going higher is if they can keep putting out long-term growth. So the thing is, if you think about some of these areas that before had very good moats and market position, things like email and the operating system and Azure, all of those things might face growing competition. So you have a company now. The question is not to say that it's going to do horribly in terms of their performance, but the question is, will people pay them multiple for a huge company that maybe doesn't put that long term does not have as clear cut of a growth narrative? And I think that's really the thing to think about. The market will price those things forward into the future. And that seems to be happening right now with software overall. But I think Microsoft, I think it's just interesting. No one yet has talked about what could be potentially market share problems of Microsoft over time, but there are early reports that it's starting to maybe kind of begin. So just throwing it out there is something just to look into. And the thing is, when the price action is bearish, people can start to focus on those things more and say, wait a second, maybe this, maybe that. The other thing to realize is Palantir. A lot of people obviously did very well in this stock for a long time. Just to realize as well, it's holding in here now. But if we do start to see a broader amount of selling, this thing trades at very high multiples. So I want to just kind of put that out there. All right. That's one thing, valuations in the market. Another thing to think about is that treasuries are, like I said, this thing with Denmark, this literally just popped up. Um, I mean, this is very strange. Denmark selling treasuries. I mean, here we are now back above 4.25. This could become a problem with treasury yields moving higher. The other thing is that Japanese yields went flying higher as well. So overall, the idea of developed countries, United States, Japan, and Europe, all of them have fiscal problems. And if yields really start to move higher, all these are sort of things to kind of be aware of as potential issues. I mean, for a long time, people have warned we could have a debt crisis in the developed markets, United States, Japan, and Europe. And well, treasury yield spiking. Denmark doesn't want to buy our bonds. Japanese yields spiking. This could be the beginning of something. At the same time, gold is going higher. All these things are kind of symptomatic of maybe that sort of negative scenario playing out. So I want to just kind of mention that. Also, very quickly, I want to mention two stocks that jumped out for me just very quickly. Of people, they might have potential downside patterns. One is Lululemon here. It's kind of interesting to look at how this stock basically had kind of held a level here right around 200, and now it's breaking below it. Another one is Decker's Outdoors. Deck, similar sort of setup here. I want to just kind of mention that to a certain extent, these are stocks that are in longer term downtrends. They've had several months of kind of consolidating and holding on. And now maybe people could see the potential of the longer term weakness to maybe reassert itself. I'm not going to get into these too much. I think you can look in those charts yourself. I did want to just briefly mention those. Another thing I think to be aware of is that last week, the American Association of Individual Investors, they did their weekly survey. 49.5% of respondents were bullish, which was the highest reading since November 14th in 2024, about a week or two after Trump got reelected. So there was a lot of giddiness then, optimism spiked, and then from there it went lower and things crumbled. Well, last week we had an optimism spike. So when it hits those levels, that's something to be aware of. AAII hitting a its highest level in over a year, that is something, and then dropping, that's something to be aware of. All right, so let me just kind of point that out. The risk of us getting sucked down. Now we turn to the weekly charts on the indexes, as we like to do. The first thing on the weekly S&P is that we had a bearish outside week slash spinning top, and now we're resolving to the downside. I have to say, if you look at this on a weekly pattern, this rising trend line broken, the support level broken. This is a problem. This is now something that you look at this and people kind of say, wait a second, I see space to the downside here. I see a lot of space down here that this might potentially look to fill. So I think we look at this now, and this is what's kind of emerging on this. And like I said, these highs are very feeble when you look at them. These have not been like really very impressive. Look at the high back in October. The high was 69.20, and then the high last week was 69.86. So you're basically, you know, something like a 1%. I'm not going to try to do the math. It's like, well, I mean, it's like 1%. That's really not very much. So these are basically slowing, weak, kind of very feeble, meek highs that are now maybe getting rejected with multiple patterns, ascending triangle, bearish outside week, support breaking. Got to just say these are things that are kind of popping up to me, and we're under that support. And so I think that these are things to be aware of. We're through the 50-day moving average now. I'm pretty sure as well on the S&P on the daily chart. So these are things that are all now popping up, and this sucks. This does set up the potential for more of a drawdown back into these range here. I think we just have to recognize that that might be the case. Okay, that was the S&P. Now look at the Qs. The Qs here, also at a spot where bearish outside week as well, and then also maybe, I mean, this point last, that the Christmas, the New Year's Day, the January 2nd low getting broken. These are potentially, I think, negative signs here. And so, from my view, people also here might say, you know what, it didn't break out, and now there's maybe space to the downside. You can also see on this chart here, just also at the weekly close that we had back here, you can basically see that we have pretty much right there, that weekly close. We stayed below it. Like we've said over here on this chart, you can see the same thing over here, but basically that same sort of pattern. Um, this channel didn't really play out in any meaningful way, but you can basically see here, you know, and this is very similar, of course, what's happening on the XLK, same sort of thing. All right, let's go now to the Dow. Now, again, we have to be careful um, when random things like the Dow or the Russell do well and the broader market does not. Historically, we've seen that strength does not last. So I want to just point that out. So at this point, the Dow here has some levels. It has like the weekly close on the week after Christmas, the New Year's week. It had a weekly close. The following week, it had a low, and that's now something appearing as a zone, but people also very well might look over to this level. I think at this point, something like the Dow becomes less important, and it's all going to just focus on the S&P. That's an important thing I think to realize. The Russell also had a lot of interesting patterns here, but I think we have to be careful expecting the strength to last if we do enter something more significant to the downside on the bigger indexes. So I think that's something that we need to be aware of. Um, Now the dollar index here, I mean, this is also a spot here where it has been in this kind of period where now we might really have that kind of confirmed lower high. So I think this is also something here where, you know, people, I now see headlines, the Sell America trade is back. And that means dollar downside, treasury yield upside, potentially gold upside, and tech downside. We got to realize it, for a long time the United States didn't trade like a normal country. It traded like multiple markets where you had stocks and you had bonds. But for most countries, their stocks and bonds trade in unison. Well, what we saw last year was we saw for the first time that I'm aware, or maybe the first time since the 1970s, that American stocks and bonds traded together. Treasuries went down and stocks went down. And that is not a good sign. That's a sign of increased geopolitical risk. It shows America is no longer being treated as a different country, as a kind of, it's being treated like a normal country. And if it's a normal country, then people might say, you know what, it needs to trade at normal valuations, which it doesn't. And that's another part of the kind of thing that might be happening here. So I think it's important to realize here that this might turn into some downside in the dollar. And I think that's a risk here. And look at the treasury yields now. I mean, this is now breaking here to the upside, and I'm not sure what to make of this. I think that the Lisa Cook news tomorrow could be very big. Whatever is announced about the Fed chairman could be very big, and we have to just kind of see. But structurally now, this does have a risk here of progressing maybe more significantly to the upside in a more substantial way when you look at this weekly chart. From my perspective, it was really set to kind of stay, back under 4.25, and then things flip the other way. So when you're in these tight periods of indecision, it's best to kind of wait and see which way it goes. And this might have gone in a direction that is not great overall for for the market. All right, that is the 10-year Treasury yield. The dollar index I talked about, the XLB materials. This has been kind of a weird, quirky thing. If we were to have more of a period of weakness, this could be something that you could see do well on and off. People could view it as a kind of alternative, hard asset, the play for hard assets and stuff like that. That could very well be something you see with XLB and materials. It is now kind of at a peak here. And so people might look for this to kind of stall around here. And this could be something where if we do enter more of a period of weakness, when the market were to stabilize and move higher, people might look for more upside in this, but for now, it seems to be at a point of stalling. Now, communications we talked about last week, and this is also something here that might be in a spot where it has potential troubles. I would just say here again, this has not made a new high since September. The XLC has not made a new high since September. So it had a very strong weekly chart, but this is now getting in a spot where this is a very tight sort of range and it's still pretty close to the high. So this might be something where people suddenly show up and start looking for some more of a push away from the highs and back down into the range. So I want to point that out with XLC. Now, energy here would be something of a geopolitical risk play. I have no idea what's happening in the Middle East. Every day I look at Twitter and I try and see are there aircraft carriers going here and there and everything else, looking at all the people who talk about oil and stuff like that, just to realize that this is now at a spot where if we were to enter a period of geopolitical risk, people might look to oil. Oil energy stocks also have the lowest multiple. So people looking to get away from high multiple growth stocks, oil offers that. At the same time, we have to realize that the oil market does face risk of oversupply. So just to kind of realize that if the geopolitical situation goes in a bad direction, that can support oil. But also it is at a spot where we are facing a situation of increased, supply potentially. And that's just something to be aware of. Now, XLF also here, had some interesting sort of patterns, but this is something I think we have to be careful of, thinking that this can diverge from the NASDAQ too much. I mean, you can see the NASDAQ and tech stocks lag and financials can outperform. But if we do start to see more of a substantial weakness in the broader market, financials are not necessarily going to perform like a safe haven. So I think right here we have to realize that these are going to be tied to economic sentiment. They're going to be tied to financial conditions in the stock market overall. So something to be aware of here. This is something where, people looking to be long, financials. I mean, at this point, I mean, the market right now looks pretty heavy back down to 6,800 right now. I mean, this might be something where people look for this to get back down closer to 51 on the XLF. XLI, same thing. This is something where, yes, we have a breakout. All these things about it look at this point. Um, you know, like strong. And we might actually say, you know what? Let's see if we get down and test back down to 161. Maybe we test back down to 158 from this high in December. Maybe those things come into play. We do have a confirmed breakout. There are fundamental reasons why it's happening. And that's something to think about. But at this point in time, there are levels that maybe need to be tested that have not yet been tested. XLK, this is the one we were showing you, also very similar to the Qs, but this is something here where we now have basically some lower highs, and it really has not. I mean, people looking for momentum. I mean, we could be just starting to see the beginning of momentum to the downside here. So lower highs, at this point, getting maybe stuck back down to the range. But I mean, there's a lot of levels down here that maybe can get tested and probed in different ways that people can look to. The low back here in November, the low in mid-December. So want to point that out on the XLK technology. I showed you the megaphone over here, which is I just noticed today, and it's like, wow, that's kind of interesting. Consumer staples is a safe haven. When this goes higher, that's not a good thing for the overall risk on market. Now, let me just say that this was outperforming. This was giving us a degree of warning, and we did mention it last week. And I want to just kind of point that out, that this has been a very good sort of, sense of sentiment, a kind of a showing, kind of a sentiment indicator. When the XLP does well, it often precedes weakness in the broader market. XLP, XLRE, um, this also has a degree of a safe haven aspect to it. It's in this range here, but also if we get into a period of real weakness in treasuries and yields moving higher, XLRE is something that people might see as a risk. XLU last week we saw a lot of a kind of political posturing against utility stocks and energy costs and things like that. Yields moving higher, potential regulatory risk. This is something here again where people might look at it and just say like, let's wait for more clarity. And I think at this point in time, also people could see a false breakout. They could see lower levels that need to be probed before they want to step in. And I think that's important. I mean, this level back here goes all the way back to like February of last year, down around 40. This might be something people look for something to get lower down there. XLV healthcare here. Um, this is also something that now is maybe trying to hold for a potential breakout. And I think that is something we should be aware of. This might be also kind of like materials. I mean, they can linger near highs and then potentially, break out when the market stabilizes and has some strength. People might also look for a test back down. Right now we're trying to kind of hold here around 153. That is the near term weekly support, but people might also want to look down closer to 150, which goes back to March of last year and also the December low on XLV healthcare ETF. XLY consumer discretionaries. This can also turn into something of a false breakout now. And I would say that Amazon and Tesla in there and things like that. Look at Tesla, potential bearish flag here on the daily. So I think right now this is something that also people will see as some potential risk, and you want to just kind of point that out. So I think right now we're in a spot where I do think that of anything I would highlight, go to my article and look at political drama, and then add a few more bullet points. That might really be what's happening now. And I would say that yes, we had the breakout in small caps. Yes, we had this shift to the quote real economy, industrials, financials, and things like that. But at the same time, sometimes these shifts in the past have simply been indications that people are not buying the leaders. And if they're not buying the leaders, the question is how long can the rest of the market hold up? So that's my main point for today. We will be back on Friday. I'm sorry, on Thursday for market trends, but also don't forget tomorrow, the Supreme Court. That is a potentially big thing. We could get tariffs and we will, and we're expected to get, we could get tariff decision and we're expected to get the Lisa Cook hearing. So hope everyone has a great day. I will see you Thursday. Thank you very much.